Do you want a safe and simple way to grow your money, even when the stock market feels like a roller coaster? Today, we're talking about bonds, the chill, dependable investment you can count on. I'll break it all down in a way that's super easy to understand. By the end of this video, you'll know why bonds might be your next smart money move. Ready? Let's get started. A bond is a loan. Imagine this: you're lending money to the government, a company, or even your local city. In return, they promise to pay you back interest regularly and return your money, called the principal, when the bond ends. Here's the formula for how principal works. So, if you buy a bond for $1,000, that's your principal. Over time, you earn interest on that amount, and when the bond ends, you get your $1,000 back. Let me give you an example to make this clearer. Imagine you buy a $1,000 bond with an annual interest rate of 5%. This means the issuer will pay you $50 every year in interest, 5% of $1,000. After 10 years, when the bond matures, they will return your $1,000 principal. So, in total, over the 10 years, you'll earn $500 in interest, $50 per year for 10 years, and get back your $1,000 at the end. Now, there are different types of bonds, and each one works a little differently. Number 1, Treasury bonds. These come from the US government and are super safe. Think of it like lending money to someone who always pays on time. Number 2, corporate bonds. Companies issue these, and because there's more risk, they pay higher interest. Number 3, municipal bonds. These are issued by cities or states to fund local projects like schools or highways. Bonus? They're often tax-free. Number 4, savings bonds. Great for beginners because they're easy to buy and very secure. Why should you consider bonds? Here's why. Steady income. Bonds pay you regular interest, so you get a predictable flow of money. It's like getting small rewards while you wait. Low risk. Bonds are safer than stocks. If you don't want your investments to give you anxiety, bonds are a great choice. Portfolio balance. Stocks can go up and down like crazy, but bonds help keep things stable. Tax benefits. Some bonds, like municipal bonds, have tax-free interest. That means more money for you. Of course, bonds aren't perfect. Let's talk about the downsides. Lower returns. Compared to stocks, bonds grow your money slowly. They're more of a long-term deal. Inflation risk. If prices rise, the fixed interest you're earning might not be worth as much. Interest rate risk. When interest rates go up, bond values can go down. This matters if you need to sell your bond before it matures. Default risk. Corporate bonds can be risky. If the company goes bankrupt, you might lose your money. Let's move on to the important part: how to invest in bonds. Treasury bonds. You can buy them straight from the government at treasurydirect.gov. It's simple and safe. Corporate bonds. Platforms like Robinhood, Fidelity, or Vanguard let you invest in these. Check the company's credit rating first. Bond ETFs. Don't want to pick individual bonds? Bond ETFs are bundles of bonds, so they spread your risk across many options. Savings bonds. These are beginner-friendly and great for saving small amounts over time. And that's the lowdown on bonds. They're safe, steady, and a great option if you want to grow your money without worrying too much. If you're curious about any specific type of bond, treasury, corporate, or even municipal, let me know in the comments. I'd love to make a separate video breaking each one down for you. Don't forget to like this video, subscribe to the channel, and hit that bell so you're always in the loop for more money tips. Thanks for watching, and I'll see you next time.